Last year, I didn't throw a single yacht party, or have a Wolf of Wall Street-esque bender. To avoid finding myself in that same miserable position again this year, I'm going to need to make some serious cash on the stock market. This is a list of 5 companies that I'm hoping will leave me rolling in the green for years to come. As a disclaimer, I either own these stocks or intend to buy these stocks throughout the year. This video is not a buy, hold, or sell recommendation, but rather me expressing my opinion regarding 5 stocks that I believe will perform very well this year. Airbnb has changed the way we travel. It's disrupted the capital-intensive hotel, motel, and lodging businesses. Airbnb is a gig economy play that allows homeowners to monetize their properties and spare rooms by providing lodging for any user of the app. Airbnb has a massive economic moat due to both the network effect component of the business and the fact the brand has become synonymous with organizing temporary lodging on the internet. Airbnb looks particularly attractive at the moment as it's just had its first cash flow positive quarter since the virus that shall not be named. If Airbnb could replicate that success again in subsequent quarters, then at its current price around $170, it would be trading on a PE ratio of about 35, which I believe is reasonable for such a high-quality business that will be benefiting from the world reopening. Netflix is a household name. Everyone either has a Netflix account or is stealing someone's Netflix account. Though the streaming industry is incredibly competitive, Netflix continues to publish blockbuster smash hit after smash hit. Netflix continues to add households every quarter, and though expansion in the US is slowing down, it's still working to capture global market share. In an even more exciting vein, Netflix has incredibly strong pricing power and will be able to continue raising prices and improving its margin for years to come. I've often described Netflix as a modern cigarette company, where no matter what the price is, people will continue to pay for it. And if you look at the long-term historical performance of Altria Group, you can see why that's an interesting prospect for shareholders. Netflix isn't priced particularly cheaply, trading on a PE ratio of 55, but I believe given the quality of the underlying software business and the continued expansion into new verticals such as gaming and merchandise, with the promise of capital returns on the way for shareholders as per the latest earnings report, I'd expect Netflix to outperform the market this year. I don't know about y'all, but I really hate passwords. There are only so many ways that I can rearrange my birthday with my dog's star sign to form a new password. Okta is the leading provider of single sign-on and identity-as-a-service technology. Their technology integrates with other applications to allow you to only have to sign into Okta to be able to access all your business app. This utility is hugely valuable for enterprises, as not only does it improve productivity, but it also helps improve organizational cybersecurity posture. The best part about Okta is that the software is like bed bugs. Once you start using it, you're basically stuck with it for life. This gives Okta unbelievable pricing power when you have a long time horizon in mind. Okta is currently unprofitable and trades on an absolutely eye-watering price-to-sales multiple of just below 30. Though this is by absolutely no means cheap, I believe Okta's incredible ability to lock in customers and ratchet up prices will see long-term shareholders handsomely rewarded. Anyone who's seen my Coinbase video knows I absolutely love this company. I'm a major believer in this company's future prospects and believe it's one of the best ways to get exposure to the adoption of crypto technologies without having to form an opinion on what asset will be the most important in the future of crypto. Coinbase has had an absolutely monstrous year from a free cash flow point of view, and the current share price reflects that analysts believe the company is going to take a slight step back in its earnings next year. Though I do agree it's unlikely Coinbase experiences trading volume similar to what was seen in Q2 FY 2021, I wouldn't be betting against it either. Using the analyst consensus forward earnings estimate for FY 22, the company is trading on a PE ratio of around 33, which I believe is incredibly reasonable given the quality of this business and its exposure to the ever-volatile, ever-exciting world of crypto. My number one growth share for 2022 is Pubmatic. Pubmatic is a sell-side programmatic advertising solution. In English, Pubmatic is basically a digital property manager that plugs into applications, connected TVs, and a whole host of other things. Pubmatic then finds advertising tenants to fill the space and collects the rent for the virtual advertising space offered. This is all done in split seconds using Pubmatic's platform. Pubmatic has a trailing net revenue retention rate of 150%, which basically means that existing clients are paying on average 50% more year on year. Though that level of organic growth is unlikely to be sustainable, it does speak to the overall quality of Pubmatic's solution, as the most confident vote a customer can make in a product is with their hard-earned cash. Pubmatic is trading on a trailing PE ratio of around 42, which I feel is very reasonable given the sticky nature of the company's earnings and its position in the ever-lucrative programmatic advertising space. That's my top 5 stocks for the year. I've created a tracking spreadsheet to hold myself accountable, and we'll try to make some follow-up videos about how we're tracking and if my opinion on any of these companies has changed. It's worth noting that in general, I'm more interested in business performance than share price performance. I believe the share market itself is often entirely irrational, and as such I focus on owning businesses that perform exceptionally well and wait for the market to overreact in my favor. Also, please remember, this video is only my opinion. This video is not financial advice, and I am most certainly not a financial professional. You may want to consider seeking independent financial advice from an actually qualified financial professional. Hope you all enjoyed the video, and feel free to hammer the dislike button if you hated it. Don't forget to subscribe and hit the notification bell so you'll get alerted when I wake up at 2 a.m. in the morning wanting to tell the world about a new Excel function. Cheers, y'all.